I have lost count of how many times I've heard this reframe. Cash value is a bad investment. Cash value underperforms. You'd be better off putting that money somewhere else. Here's the reality. Every time it comes up, I know something before the conversation even starts. I know that more than likely the person saying it never truly understood what cash value was designed to actually do. They've heard snippets from an article, maybe a blog, or even a heated comment thread. And from those things, they have decided that if something isn't the highest returning asset, that it must be worthless or it must be useless. And at the end of the day, that mindset is exactly why so many people stay stuck. So what I want to do is I want to clear up the loudest claim right away, because this is where the internet gets loud, and I mean extremely loud. Cash value is not an investment vehicle, or at least not in the way that most people use the term. And to be fair, the internet is partly right. But where it goes off the rails is what comes next. People hear it isn't an investment and immediately jump to the conclusion that it must be useless. They think if it's not beating the market, then why bother? And that assumption is the real problem. I've been on both sides of the table. I've competed at the highest level where risk, leverage, and protection determine whether you kept your job or, quite frankly, you lost it. And I've also sat across from families and athletes as well as entrepreneurs who needed certainty before they could even think about opportunity. So here's what I've discovered. Every financial tool is only good or bad based on the job it was built to do. You see, cash value is not designed to replace a growth portfolio. It's built to support everything else in your financial life. This is where the conversation needs to actually shift. You see, cash value was never meant to compete with the stock market. It was actually designed to support the rest of your strategy. So trying to compare cash value to, let's say, an index fund would be like using a screwdriver to nail or hammer a nail and then complaining that it doesn't work, right? You're asking the wrong question. Cash value life insurance is a form of permanent coverage with two key components: a death benefit and a cash account. Part of your premium pays for the insurance and the policy expenses. Then the other part goes into a cash account that grows tax deferred and can be accessed during your lifetime. So you can borrow against it. You can withdraw from it. You can even use it to pay premiums. But to put this simply, cash value is a capital positioning tool. Its purpose is not maximum growth. Its purpose is stability, access, and control. What it does is it provides a lifelong coverage and a peace of mind. It gives you access to capital through policy loans or withdrawals. And that cash account grows over time and can be used for emergencies as well as for opportunities such as investments. So instead of chasing market returns, cash value gives you a place to store your money efficiently and then grow it steadily and access it without penalties. It protects against volatility. It lets you borrow at favorable terms. And it also offers tax advantages. That's not what a stock portfolio does. That's what infrastructure does. Now, somebody is probably already thinking, but hey, the returns are lower. Of course they are, right? Seatbelts don't help you win races. They help you survive crashes. So holding cash alone is risky as well. Cash carries a massive opportunity cost. And it also exposes you to losing purchasing power when the yields are low. Long-term studies have always shown that stocks have consistently outperformed cash over time. So cash value doesn't try to beat those returns. But instead, what it does is it offers stability, tax advantages, and liquidity while other parts of your portfolio are pursuing growth. And the reality is even critics will tell you this. Whole life and universal life policies are more conservative and more expensive than a traditional brokerage account. So if your only goal is high returns, a brokerage account makes more sense. But if you value stability, if you value security, and you also value controlled access to capital, cash value belongs in your toolkit. And here's what the internet often misses. The wealthiest people don't swap stocks for cash value. They pair them. You see, cash value becomes their volatility buffer, their liquidity engine, their private reserve, their source of tax advantage borrowing. They treat it like a fuel tank, not the engine. So when markets crash or opportunities arise, guess what? They already have capital ready. They don't have to sell investments at the worst possible time, as we've often seen sometimes with real estate. You see, money doesn't just need to grow, it needs to be available when opportunity knocks. Predictability so you can plan your life, protected from market swings and creditors. And it also needs to be positioned for leverage when you need it most. Cash value exists to solve those problems. So understand that, and then the argument disappears. But here's the real question. Are you judging cash value based on what the internet commenters are saying? Or are you judging it based on what your financial life actually needs? Because those two things are rarely the same. And if you're building for legacy, not headlines, or if you value control over comparison and structure over speculation, then you already get it. Cash value isn't meant to impress strangers. What it is it's meant to support builders like you. And I need you to remember, you're going to always be one strategic decision away from your next level. Run well, young lions. In lionesses, Tony the Tycoon. I'm out.